Hey Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, we're going to talk about something that I call the nine knockdown of Bitcoin. Okay, so what we're going to look at is actually the weekly, where our 9 EMA crosses over our 10 MA, and we're just going to see what type of effect that has on price action when price gets rejected by the basically the 10 MA. Okay. So if you don't know what I'm talking about, EMA is the exponential moving average, and MA is just regular moving average. So the EMAs respond a little bit faster. I like using the 9 EMA. A lot of people use the 10 EMA. You can go ahead and just look at my settings for EMAs right here. I like to have as many as possible because I am primarily an EMAs trader. But then again, I also keep the MAs because the MAs do have a lot of importance. And so I'm not one of these people who thinks that EMAs are better than MAs or MAs are better than EMAs. I like using them together. Okay, so if you got a screenshot of that, we'll move on. And guys, look what's happening right here on the chart. Okay, so I've told you this many times. If we get ahead of the 10 MA on the weekly chart, that what can happen is actually that we get put into a very bullish position in terms of the macro. Anytime that we've been on top of the 10, we tend to be in a bull trend. If we get underneath the 10, then we tend to be in a bear trend on the macro. And so what happened here by being rejected by the 10 pretty harshly is that we actually got rejected from the case of being in a bull market or a bull trend, okay, sort of like this. And it just means that we probably have to build up some energy in order to make a second attempt. Now, I told you many times also that I prefer using the 5 EMA just to define the bear market, and that's because you can see whenever we get slapped down by the 5, it is just a punishingly, hard ride down. The 5 is really the ultimate gatekeeper, and if you can't break through the 5 on the weekly, I mean, you may not even be able to touch the right the 9 there, right? I mean, you can get these kind of wicks, but it can really just slap you down really hard, and the main thrust of that does come from that 9 EMA, that 10 MA, and they all move pretty tightly together. You can see when a market breaks down according to if price action violates that 5 or the 10s. Again, you can have your own preference. I learned about the 10 from my friend Crypto Reda, and then I altered it by adding the 5 to make my own style. I just like it because it's a little bit more responsive. Back to the point of this video, you can see that where the 5 pardon me, where the 10 MA and the 9 EMA crossed over bearishly, right? Or I guess this could be considered bullishly, but anyway, whenever they crossed over there, it had a bearish effect on the market, which is the sense that the market rejected and price got sent back down. Now you may be asking, well, how far can we expect the price to be sent down? Well, let's go ahead and just see if we can find these crossings elsewhere, right? So of course they crossed over here bearishly and we got sent all the way down. But what happens when they cross bullishly? Shouldn't we expect the market to pump? Well, not necessarily. You see, that's the quirk about it. That's why you have to kind of learn the interesting behaviors of these EMAs because look here, they're crossing bullishly, but what happened as the 10, this a thin red line, the 10 MA, and this a thick red line, the 10 EMA, went to cross over. What happened is the market took a huge hit to the downside. Now you would expect, well, they're crossing bullishly, right? They're meeting to cross bullish. Why is it getting this slap down of approximately 25% from these wicks, okay? And even if we count it just from the tens themselves, that was a solid 20% smackdown. And it's just the way that the market kind of builds in energy before it puts in that pump, which really occurs between the 20 EMA and the 10 EMA, right? It's not really about the 10 MAs. And so in this area between the 5 and the 10 MA, we're really talking about kind of like charging up the market, right? Like the market's kind of charging itself up for whatever possible squeeze may be about to happen. And it just hasn't happened yet. So in order to build up some energy, you get this 20% pullback. Now, again, like if they cross negatively, it can be a hugely bad market. But when they cross bullishly or are threatening, that's kind of the important point. It can also be just a threat where they're squeezing together. Under the threat of them crossing bullishly, the market tends to take some liquidity to the other direction. And so, look, we can see it here, right? So here, they're actually crossing positively, but as they started to move together and threaten to cross positively, what happened? Well, you can notice the threat really in this area. So let's take the wick high here, and if we drop it down, look at that. 20%, right? 20% to the downside. And then, of course, when they crossed bearishly, we just had a huge downturn, right? So this crossing is not good, or at least the approach of that crossing is not good either when it's bullishly crossing or when it's bearishly crossing. It's not good either way. Here we have a bullish crossing where it's in a clear macro uptrend. And so, there was very little effect, but you can see that the interplay here, let's see if I can just turn off price action. You can see that as they had an kind of an interplay, right? Like it's up and it's down just really quickly. During that interplay, we did see this kind of weird price action, which approximately here was 10%, right? And as it flipped from here to here, you actually saw a pullback of 20%. Okay, so these type of a 10 and the 10 MA and the 9 EMA flips, they can kind of cause a little bit of a ripple, right, in the price action that you can predict to be around 20%, whether it's bullish or bearish. But a bearish crossing could have a huge implication of a much bigger down move, right? But anyway, right here, we actually had a threat to the positive side. Of course, this was more convincing. This was from the huge rally from the virus era, right? The money being pumped into the market. And again, like as they kind of had this kind of like wobble in the chart, what you really saw was basically this kind of like 16% move right there. And let's see, at the bottom of this market, here's a pretty clear example. This is see, some of these have like a upward pointing, but some of them have downward pointing. The downward pointing is much more similar to our current situation, and I'll go back over that. But look, you can see these are threatening to cross in a bullish way. They're threatening to cross bullishly. Bullish just means that this faster line is going to flip onto the top, whereas the slower line is getting underneath. And so, what do we see as a drop here? Lo and behold, 20%, guys, 20%. So this number just comes up over and over again, and I want you to pay attention to this, right? This is where they're threatening to cross bullishly, but they're both pointed sharply in a down direction, right? Whereas in this case, they're threatening to cross over bullishly, but one of them is pointed strongly in an upward direction, right? We don't see the same type of pullback here. We do get this pullback right here, which is 10%, but it's not as intense as if they were both sharply pointed to the downside, right? And then, of course, you see this here where it's basically just flat. Like this is basically just, straight up almost, and this one's straight down. They kind of make an X formation, and you really only saw a decrease of about, again, like around 10%. So if there is some bullishness to the direction of the MAs, then you are going to perhaps take a little bit of that edge off the 20%. But again, the reason why I'm mentioning this is because you can see that we have this bullish crossing going on, but it's sharply to the downside, right? And so what would we expect from that move? Well, we have the 10% right here, okay? So if we just take the minimum, let's just say that this just decides to flip up, okay? Like this thing just goes. We've put in the minimum, but what should we consider our risk to be? 20%, right? And 20% would bring us where? Oh, look at that. Precisely to the bottom of our range on the weekly, at least on a candle closing basis, right there at around 19,250. So, guys, this is what I'm trying to teach you today. Sometimes I go into a lot of detail and cover multiple subjects, but I'm going to try to just cover maybe just one topic at a time. So, look, if we do see this cross playing out, then potentially we could get some type of rejection to here. Now, here's the trick about it. That's a bullish crossing. It's a bullish crossing that results in temporary pain. It's almost like it's charging, right? It's kind of like charging up. It's fueling the gas tank basically, right? It's front running the rest of the moves. And so if we get fueled up, right? If we get fueled up at the measured move, then potentially we can just bounce off there and go, kind of like a double bottom on the weekly. That could take a little bit of time to play out. It could take a week or two to play out, but worth watching. And also, we have to understand this in the context of not just being rejected by the 10 MA, but also we're losing the 5 EMA and we're losing the 200 MA, right? Which takes a lot of work to break through. So that's not good for crypto, right? Like this thing could go down to 19,000, or it could just get sent down as we get held under by that 5 EMA, which I told you it's like poison. You see this pink line? It's like poison for the chart. As long as you're stuck under that 5, like you can actually get trashed really badly. So, guys, that's the risk that I wanted to share with you today about, when we're looking at EMAs and why I use EMAs. Uh, I often disregard horizontals more than I probably should, but it's only because there are so many other tools in trading. Like you don't always need to be just using one, standard set of tools. You can think outside of the box. You can look at things in a new way. And as we approach this level where we could be breaking down our daily RSI, let me just double check the numbers there. Yeah, I mean, we're basically uh, what's going on here actually? So that's the weekly. There we go. Okay, so we've already broken our daily EMA here. So yeah, I mean, I guess it got moved up, but yeah, that's too bad. Yeah, well, yeah. Oh man, yeah, we're 21,900. So we've been moving down, and I really set that standard as like a 22,000. I seem to have moved this one a bit. Just go ahead and just update those coordinates. 22, what was it? 122, 125, something like that. But would love to recapture this line, guys, right? Let's go ahead and see what our daily momentum is over here. And Yeah, we're going to. I mean, we still are bullishly postured, but we're going to cross below at 18,000. We have plenty of space, but unfortunately, we're still softened under 22,350. So, an even higher bar than this RSI. So let's get the RSI first. But yeah, it looks like we're headed down, and see if we can't capture that bull flag that we were putting in. Getting, we're just tagging the daily 20 EMA, but we really don't want to go too far below here. Like we're really pushing the limit. This is technically, I mean, this is why I love EMAs, guys. Like we're technically squeezing to the downside, okay? And in fact, you can see when we violated that 10, like we got squeezed down. So we need to hold this as support. Or at least this 20 MA, and get flung up from there. But it's just looking kind of bad. We are bouncing a little bit right here, but the bears are trying to take control. And all these EMAs on the daily, I don't know if you can tell, they're all starting to just flatten out or put in negative curves. And that's not a good thing. That suggests that 20% move that I was talking to you about could potentially come to play. So be on the lookout for that. Beware. We did see something similar here using other. Let's actually see if I had a weekly crossover. No, this upper zone didn't even get the chance for that. But yep, on the daily, you did see something similar where you had a bullish cross here, and then on the daily, it pushed it down 10%. So you had a daily one up here, and it got that 10% knockdown. But we're getting a weekly potential crossover to the downside, and it's not guaranteed. It's not guaranteed to play out 20% down. But again, guys, like from that wick to the downside, that's going to be 19,000-ish, okay? All right, just trying to share some of the tools that I've developed for myself in analyzing the market, and I'm not sure if other people have ever used this cross before in order to like think about that type of pullback, at least not with the metrics and the statistics behind it. But I went ahead and did that for you. So there's your alpha for the day. Stay safe and happy trading.